All right, let's figure this out. What happens the exact second a business hits 3,001 pesos in sales? Welcome to this explainer. If you're a BS accountancy student gearing up for the LECPA, you are in the perfect place. We are going to map out the EOPTA VAT rules together. And more importantly, we'll go over some killer study hacks so your brain actually holds on to these tricky tax concepts for the next 2 to 3 years. Let's dive right in.
Here is our rapid-fire game plan. We've got mandatory versus optional registration, the franchise exception, the breach timeline, penalties for non-registration, cancellation rules, and we'll cap it all off with an LECPA rapid-fire review.
Starting right off with Section 1, mandatory versus optional registration rules.
Okay, so the absolute biggest number you need to burn into your memory right now is 3 million pesos. Under the Philippine setup, 3 million in annual gross sales is the hard, mandatory threshold for all non-exempt businesses. If a business crosses this line in the past 12 months, or even if they just have reasonable grounds to believe they're going to cross it in the next 12 months, boom, the BIR says they must register, no exceptions.
Now this brings up a really interesting question. Crossing the 3 million mark means you literally have to register. But why on earth would someone voluntarily subject themselves to VAT if they make under 3 million? Well, here is your massive study key: input tax credits. By opting in, businesses can actually claim input VAT on their purchases and pass those credits right on to their VAT-registered customers. It basically makes them a way more attractive B2B supplier.
But wait, here is the ultimate exam trap, so listen closely. If a business goes for optional registration just to grab those input tax credits, it is not a free trial run. It is strictly irrevocable for 3 straight years. You absolutely cannot just back out the next month because you changed your mind. The BIR locks you in for 36 months. Board examiners absolutely love testing this specific retention period, so engrave that 3-year rule into your brain right now.
Moving on to Section 2, the franchise exception for radio and TV broadcasting.
If you ever see a radio or TV broadcasting franchise grantee pop up on your exam, your brain should immediately flip a switch. For this highly specific group, that mandatory VAT registration threshold jumps massively. We're talking 10 million pesos in annual gross receipts for the preceding year.
And here is the really crucial point. While their threshold is way higher, the trap for optional registration is vastly different. If a radio or TV franchise grantee makes under 10 million, they usually just pay a percentage tax. But if they voluntarily opt into the VAT system to claim those sweet input taxes, that choice is permanently irrevocable. Not 3 years, forever. Seriously, do not let the board examiners catch you confusing the standard 3-year lock-in with this permanent one.
Let's look at Section 3, the breach timeline and EOPTA updates.
This right here is pure EOPTA mechanics. Let's say a non-VAT business suddenly breaches that 3 million threshold in August. They are required to update their BIR registration immediately, within the following month, so by the end of September. But here is where the magic happens. Their VAT liability is actually prospective. It starts on the very first day of the month following their update, so that's October 1st. Think of the flow: breach in August, update in September, liable in October. This timeline is prime multiple-choice material, guys.
All right, Section 4, non-registration penalties and risks.
Think about this like an examiner for a second. How do we effectively punish a taxpayer who crosses that 3 million mark but totally ignores the rules and fails to register? Well, it's not just a little slap on the wrist. The financial consequences are literally designed to be devastating to their cash flow.
The brutal math of the penalty looks exactly like this. First, the BIR assesses you for output VAT on all your sales. But you are not allowed to separately bill that VAT to your customers. You can't shift the burden, meaning you have to pay it entirely out of pocket. And the real kicker? You get absolutely 0 input tax credits on your purchases to offset that liability. Nothing. Zilch. Add in the hefty fines and the very real threat of an O-Plan Condado business closure, and you can quickly see why failing to register is a fatal error for any business.
On to Section 5, cancellation rules and legal exit strategies.
So how do you legally get out? These are our standard triggers for VAT cancellation. Ceasing operations or officially retiring from business is pretty straightforward, but where the exam really tests you is on entity changes. If there's a change in ownership for a single proprietorship, or if a partnership or corporation is dissolved, those are major legal triggers because the entity fundamentally changes. Also, if the business model shifts entirely to exempt transactions, they can officially apply to cancel.
And look at that, we are right back to our anchor number. If a mandatory VAT-registered taxpayer suffers a downturn and their gross sales drop back below the 3 million peso mark, they don't get to just cancel immediately. Nope. They actually have to prove that their sales stayed under that threshold for 3 consecutive years. Only then will the BIR hand over an exit ticket back to non-VAT status.
Finally, Section 6, our LECPA Rapid Fire Review.
All right, here is your active recall study hack. Take a mental screenshot of this right now. Standard threshold, 3 million. Franchise exception, 10 million. Optional registration, that's a 3-year lock. Unless you're a franchise, then it's forever. Threshold breach, prospective liability starting the next month. And the penalty for non-registration? Absolutely no input tax credits. If you can master these 5 core concepts, you are golden for the absolute toughest VAT traps they can throw at you. I want to leave you all with this final thought today. VAT isn't just about filing boring forms. It's actually a very serious financial strategy. If a business voluntarily registers today just to grab some quick input tax credits, they are making a binding legal commitment for the next 1,095 days. Are the short-term savings really worth the long-term compliance headache? Remember, tax strategy is a long game. Keep studying these dynamics, internalize how the rules actually work together, and you will absolutely crush the LCPA. Until next time, keep learning.